The United States government is the largest and safest issuer of debt in the world because it has never defaulted on a loan. The US government issues debt in two distinct markets. The first, the money market. In the money market, the US government issues debt with a maturity of 1 year or less, so 365 days or less. In the capital markets, the US government issues debt with maturities of more than 1 year. I know from years of experience that many people hear these maturity dates completely incorrectly. So I'm going to repeat this. Money markets have a maturity of 1 year or less, not less than a year. The US government is the direct issuer of 6 kinds of securities: cash management bills, treasury bills, treasury notes, treasury bonds, strips, and tips. Let's walk through each of these. First, cash management bills. There is no regular schedule for the issuance of cash management bills. The government chooses to issue these when it needs to raise money. Treasury bills are issued weekly on Monday, always with 3-month, 6-month, or 12-month maturities. They're issued through a process known as a Dutch auction underwriting. This type of underwriting consists of two components, a competitive bid component and a non-competitive bid component. Let's start out by looking at a competitive bid component. All US government securities dealers must bid in the weekly Treasury bid auction. They will bid on a certain amount of the total offering up to limits set by the government. And they will bid what's known as a discount yield. That means that these securities would be issued at a slight discount to par value. And in 3-month, 6-month, or 12-month increments, they will mature at par value. So the dealers bid on the amount of the discount at which they're willing to buy these securities. The non-competitive portion are people like you and me. We submit our money through a service known as Treasury Direct, and we agree to accept the winning bid that comes from the competitive bid portion of this offering. So, as a non-competitive bidder, you don't know the discount at which you will buy these Treasury bills in advance. On Monday, the securities are issued at a discount, and part of your money is returned to you via a Treasury Direct, and you have bought the Treasury bills at a discount. Now let's look at the quote for a T-bill. Nothing better than a T-bill. As you will see from our example, we have a bid and an offer. But look at these carefully. When you look at most bids and offers for securities, the bid price is lower than the offer price. But in this case, the bid is higher than the offer. This is because this is a discount yield quote, not a price quote. Using formulas, you translate those into actual prices. Now remember, something you've learned earlier in bond basics: the higher the yield, the lower the coupon price, or the lower the price. So in this case, the bid yield is higher than the offer yield. Therefore, when they're translated into dollar amounts, the bid price will be lower than the offer price, as it should be. Only Treasury bills are quoted this way, where the bid quote is higher than the offer quote. So if you see this on the test, you can recognize a Treasury bill quote when you take the exam. This is only possible with a Treasury bill, or a Treasury note, or a T-bill, I'm sorry. Let's look at a T-note. T-notes have a maturity of 1 year to a maximum of 10 years. These are issued at par value, $10,000, with a coupon rate of interest. Now, in reality, you can buy these for as little as $100 each. However, for the purposes of the test, the par value is $1,000. Next, we have Treasury bonds. Treasury bonds are issued with 10 years or more, to a maximum of 30 years. So we have T-notes, T-bills, and T-bonds. Like T-notes, Treasury bonds are issued at par value, $1,000, with a coupon rate of interest. For many years, those were the four basic kinds of U.S. government securities. Then the government became a little bit more creative. One of the first new types of securities it issued is known as a strip. STRIP stands for the separate trading of registered interest and principal securities. STRIPs are the U.S. government's version of zero coupon bonds. Remember, a zero coupon bond is issued at a discount and matures at par value and pays no interest over the life of the security. The U.S. government does not issue these securities directly itself. Instead, it authorizes the primary U.S. government securities dealers to take certain bond offerings and note offerings and strip the interest payments separate from the principal payment. Let's look at a simple example to understand this clearly. In this example, we have a Treasury note with 10 years to maturity. Over the 10-year life, how many interest payments would be made on this T-note? 20, because they're made every 6 months. And then at the very end, there would be one principal repayment. The government issues the notes, and the primary U.S. government securities dealers strip the interest payments from the principal payment, and they create 21 separate securities. Each of the 20 separate interest payments become a zero coupon bond that's issued at a discount, and the principal repayment becomes its own zero coupon bond issued at a discount. So these are exactly like zero coupon bonds, except they are backed by the full faith and credit of the United States government. Although the government does not issue these directly, they're created by the authorized U.S. government securities dealers. The next type of U.S. government security is called TIPS. This stands for Treasury Inflation Protection Securities. These are designed to protect people who buy U.S. government securities against inflation risk. These securities are issued at par value with a coupon rate of interest. Every 6 months, the par value is adjusted according to the performance of the Consumer Price Index. If the Consumer Price Index shows that there has been inflation in the economy, then the principal is adjusted upward according to the formula. If the Consumer Price Index shows that there has been deflation in the economy, then the principal is adjusted downward. Remember that your coupon payment is based on the principal of the bond. So if the principal is adjusted upward, then the next coupon payment will be higher. If you hold a tip to maturity, you will receive the greater of the inflation adjusted amount or par value. This tells you that in a deflationary situation where prices are falling and the principal is dropping below par value, you have nothing to worry about when the bond matures. Why? Because you will get back par value. These securities are currently a keen interest to American investors who are worried about inflation after this very, very unstable period of interest rates in the United States. In this section, I've covered cash management bills, treasury notes, treasury bonds, strips, and TIPS. These 6 securities are direct obligations of the U.S. government. And remember that the price of treasury notes, treasury bonds, strips, and TIPS are quoted on 1 30-second basis. That's the minimum price move, and the price is quoted as a percentage of par value. So if you see a Treasury note, bond, strip, or tip quoted at 99, call in 24, that's 99 and 24 30-seconds, or $997.50.